Today we're going to go through a lot of stuff, and some of the stuff we're going to talk about I think will help you personally, financially, kind of post-divorce, and then some things you need to know specifically as you go through divorce. And if we start off by talking about what is the process choice that you're going to choose to use as you go through the divorce. Ron Oski spoke about that this morning, and if you recall, you have some different choices to make from, down at this end where you kind of work on it yourself, then mediation, then just collaborative law, there's negotiated settlement, and then there's litigation. And the process choice that you use can really end up driving how much you end up spending for your divorce. So if you're kind of down on this end where this is where you have more client control, whether it be doing it yourself, mediation, or collaborative. It tends to end up being that you end up having a little bit more control over the cost, and I think end up being cheaper than if you're down on this end. Now, there's just a few other tips I want to give you for as you work with professionals going through the divorce process. Keep in mind that your attorney's rate is probably, if you look at the professionals that you may be using going through your divorce, you might have an attorney, you might have a financial professional, you might have a therapist or a coach. Attorneys tend to probably charge the highest. Us financial professionals are probably next, and therapists tend to be under that. And it has nothing to do with the value they provide, it's just market driven. But often you end up using your attorney as a therapist, and some are very, very good actually at talking with you and handling the emotional side. Judy specifically is excellent at that. But if you think about it, do you want to pay that attorney's fee to do that? Or might there be a better way to do that? And some things to think about are, keeping in contact with the people in this room. If you're going through some tough emotional things, maybe you have to have somebody to talk to. Maybe using the people in this room would be helpful. Or if you have friends and family, that can help you. And I really think, in certain situations, I think it'd be a great idea to have a therapist or a coach. Coaching is just about helping you get through the divorce and help you divide out the financial decisions from the emotional decisions. And I do a lot of that too, because you don't want your emotions to drive your financial decisions. What you're feeling for that period of time, if you're feeling like this, I don't know for how long, however long your divorce goes, you're feeling horrible and emotional here, but the decisions you make could end up impacting you for 30 years. So you want to try to see what you can do about separating those. So using a therapist or a coach makes a ton of sense. And then from there, a few other notes. Very often people will call their attorneys often, maybe 5 times a day, 5 times a week. Some ideas are when you have questions, just jot them down and accumulate them, and then pick up the phone and call your attorney or send them an email. What I will tell you, when you're out interviewing attorneys, don't choose your attorney based on their hourly rate. You're going to be making some of the biggest decisions of your life here, and you need to have somebody that you really connect with, that understands where you're at and you're very comfortable with. So don't necessarily just choose the cheapest hourly rate. If you end up in an adversarial process and you have a lot of financial assets and you need to go to court and fight this out, you might, you're going to be down here on the litigating end. You might end up hiring an attorney who's $300 to $400 an hour. You don't need to. Hopefully you're going to be down here in kind of the collaborative and mediation type environment. And often those attorneys, end up being somewhere between $200, $250. Some a little lower, some a little bit more, but that's probably, what to expect. When we look at doing like your personal financial planning, there's a process you go through for your personal financial planning, and it really is kind of a similar process that you need to go through as you make your divorce decisions. The first phase we have is called cash flow. Cash flow is just kind of money in and money out. It's just kind of what you've spent. A budget is actually a system to help you follow some guidelines for spending. So a budget is kind of your goal for how much you're going to spend in certain areas, where cash flow is just what you spent, okay? So the first thing that's very, very important, whether you're doing personal planning after divorce or during divorce, is to understand what the heck your cash flow is. If you don't have a feeling for how much you're spending in certain areas, it's really hard to develop the plan. And understanding the cash flow and what your needs are is really going to drive an awful lot of the financial decisions that are made in your divorce. So keying in on this is critical. The next phase, phase 2, is financial planning. And in a financial planning process, this is where I'll sit down with a client and walk through what are their values and what are their goals, what are they trying to accomplish. How long do they want to stay in their home? Are they looking at an early retirement? What do they want to do about educating their children? What about estate planning? Do they want to start a business, go back to school? All those kind of things fall under financial planning. Once we have a feeling for what the cash flow is for the family, and we know what your goals are, then it becomes very obvious as to what we should do with the assets. By that I mean, after we know how 1 and 2 kind of play out for you, it will be very clear to us as to which of the family assets make more sense for you to have in your column post-divorce, post-divorce, or if you're done with a divorce and you're doing your own financial planning, and if we've walked through these steps, it's going to be real obvious as to how to allocate your assets, how much to put into a 401k, how much to put into a Roth IRA, how much you should be just putting into a savings account. So often people just jump right here and want to try to figure it out without going through these steps. And I think you're going to make some mistakes if you don't follow the steps. I'm going to draw for you the average American spending pattern, okay? So first, what happens with us Americans is when we get our check, so whether it's a paycheck or child support check, whatever, we end up spending that money on what I call standard of living. Standard of living would be, the house we live in, the car we drive, the food we eat, the clothes we wear, those kind of things. If we have any money left after that, then we'll put some money away into a savings account, right? And I always smile a little bit when I hear savings account. I call them deferred spending accounts. We put the money in, and then later we end up using it for putting tires on our car, or replacing the furnace, or going on vacation, or holiday spending, or those kind of things. Then, if there's any money left after that, then we pay ourselves. By pay ourselves, I mean put money away for those things that are truly the most important to us. And again, that could be an early retirement, educating your children, perhaps if traveling's a passion for you, putting money away for that. But so often, this is the last thing we think about. And if you can believe it, I know it'll be a big surprise to you, many Americans don't make it past this point. You'll know if you're there when you're doing your monthly budgeting and all of a sudden your car needs some maintenance and you have a $400 bill and you have to juggle things around to pay it. That means you're here, okay? And if you can believe it, again, quite a surprise, many of us Americans actually extend our standard of living through the use of credit cards. Yep, exactly. And what we need to do is, we're working down this way right now. That's how most of us work if we're not really thinking about it. We need to change the way we're thinking. We need to be conscious about it, and we need to instead move up this way. We want to, put money away for the things that are really the most important for us. Make sure we are putting money away so that we can go on those vacations and spend money at holidays and fix our car and not stress about it. And then, with what's left, that's kind of determines our standard of living, and we need to learn to just stop here. And so to kind of shift from, doing it the way most people do it, and moving this way, it takes some time. It really does. But we're going to kind of keep talking here, and I hope we'll come back to this, and we'll kind of give you some tips on how you might start to move up this way. And I think if nothing else today, if you can just recognize where you are in this and just make one step forward to correct it, I think you're going to be probably ahead of most Americans out there. I work often with husbands and wives together where I'm a financial neutral, and so I often will help them figure out what their needs are, what mom needs, what dad needs, what the kids need. And sometimes I just work with an individual to help them figure out what their needs are. So this is an example of all the different kinds of expenses that we're going to need to get kind of a feeling for what you need. It's utilities, it's food, it's house and car maintenance, insurance, those kind of things. And when we put together the budget, again, remember, we really want to make sure we got the right numbers. So if I give this sheet to somebody, the idea would be that they would go back and fill this out for the last 6 months. So you would just take out like your checkbook, get out your credit card statements, canceled checks, and just kind of start filling in the blanks, right? Now, if somebody brings this into my office and it's all like round numbers and it's just filled out in one column, like $100 for food, $50 for clothes, I know that this isn't accurate. And again, it may be easy to do that, but again, most people tend to underestimate when they're guessing. When you actually sit down and do this, you end up finding some surprises actually. So to put together an accurate budget again, some things what you want to try to do is just gather your historical data. You want to try to look back for at least 6 months. If you can do 12 months, that's great. The reason you want to look back over 6 or 12 months are because sometimes you have expenses that aren't regular monthly expenses, and we need to make sure we capture them. And again, that would be like the holiday spending, or even energy costs are different in the winter versus the fall. Home maintenance or car maintenance might not pop up every month. So if we're going back 6 or 12 months, it's going to help us to get more accurate numbers. Now, once we get these numbers, what then I do is I just take them and average them to come up with some average expenses. And from there, if we, I usually start off with, like jotting down family historical expenses. And, we'll have them all listed down here. Then from there, once we know what you've been spending in the past, it's going to make it much easier for us to project going forward what your needs are. So then we can make a column for the kids, one for mom, one for dad, and start just kind of working through this. So as an example, if you're going to stay in the home, we can carry over the mortgage and utilities to your column. Food. If you have a feeling for how you're going to share your parenting time, it'll help you figure out how to allocate food. If in the past you've spent $600 for your family a month on food, and if you're going to be the primary person who has the kids the majority of the time, you might end up having $400 a month. Your spouse might end up having a few hundred a month. So can you see how it's really hard to project the needs without having some kind of history to use? Now this, from here we do have to think about what things didn't come up that might, what might some new expenses be? And that could be, if you're going to stay in the home and maybe your spouse was the one that was kind of handy, so they did a lot of things around the house, so your home maintenance costs might have been much lower than they're going to be if you stay there alone. Same with car maintenance type things. Or what about medical insurance, right? If you're covered under your spouse's medical plan, you do have the ability to continue that coverage through COBRA provisions or Minnesota continuation coverage. Through COBRA, they actually allow you to continue coverage through your spouse for 36 months. However, the company doesn't necessarily have to pay for it. The cost is passed on to you. And kind of a starting point is to go back to the spouse's employer and get a quote from the employer for the COBRA coverage. And if it's $340, that might be just fine, and that might be a decision that you decide to keep that. Other options for you, though, are to go shop it out individually. And if you're healthy, that might very well be what you end up doing. Now, keep in mind, too, medical coverage through COBRA goes for 36 months. If I have healthy women that I'm working with, often we will just go get the individual coverage, because what if during that 36 months something happens in your medical situation that then causes it to be hard for you to get coverage after the 36 months is up. So those are some kind of things that you think about with, when you're going through cash flow. Also, what about retirement savings? You might not be doing retirement savings yourself. Sometimes people might decide to do most of it through one spouse. Maybe they have the better 401k, maybe they're getting a better matching. They might have better options. So if you don't have savings going on for yourself, we might want to figure out what do you need to do for savings. And of course, housing. If you're looking at buying a new house or refinancing the house or those kind of things, we would be crunching the numbers to figure out what might a new potential mortgage be and working that in. I love when I work with husband and wives together, to kind of work through this and figure out for the family, how do we spread the household income amongst the kids and mom and dad, and try to just kind of make this work. And what I will tell you is when you do budgeting, sometimes it's not always possible to keep spending the way that you have been in the past. Sometimes you can, sometimes you can't. It really depends on what your family's resources are. But if you think about it, let's say that mom makes $80,000 a year, let's say dad makes $40,000 a year, and you've been using that income for your one home. Now, all of a sudden, you have to have 2 homes. The money can only be stretched so far. If you happen to be doing just a ton of savings and investing, then perhaps you can slow that up and afford 2 homes. But most likely, most people end up having to cut in some areas. So just be ready for it. let's say that we want to change our ways. We want to be more conscious about how we're going to do our budgeting going forward. So this is a process that I think works well for a lot of people. Maybe you can find something in here you can use. So let's say divorce is done. We have kind of your budget numbers laid out. Now what we can do is take those budget numbers and we want to break them down into 3 different categories. We have fixed, escrow, and discretionary. Under fixed, who wants to give me some ideas of what falls under fixed? These are regular recurring costs that might be the exact same amount or close to the same amount every month. You don't really have a choice about paying them. Car insurance, car payment, mortgage, health insurance, student loans, yep. Utilities, yep, exactly. All those things fall under fixed. Okay, escrow are going to be those kind of expenses that don't come up on a regular basis, but you want to make sure that you're taking them into consideration. What would those be? It could be life insurance. Some people pay car insurance, semi-annually. Property taxes if you don't have those escrowed. Home maintenance, car maintenance, holiday spending. Could be SEP contributions, yep. Could be any kind of insurance, whether it's long-term care, disability, or life insurance if you're not paying it monthly. And this changes for people. Like I tend to buy my clothes seasonally. I kind of hate shopping, so I do a big trip in the fall and then one in the spring. So my clothes would be kind of escrowed here. Okay? So now let's talk about what is discretionary expenses or living expenses. It's kind of everything else. Your coffee, coffee, food, groceries, hair care, massages, children's costs, gifts, fast food, dining out, entertainment, yep. And this is where we all get in trouble. This is where it's really easy to overspend in this area. Okay, so now let's say we take your budget and we kind of break it down so we know, once we break this down here, how much you need in each area. So then what we can do is we can take if you have the money that you have coming in, we would filter enough in here. Let's say fixed expenses are, let's say they're $1,500 a month. We can make sure that this account, and we would have like a checking account, a household checking account, let's call it. We would make sure that we have $1,500 a month going into here so that we can cover all these expenses. Here's the real key. For this escrow account, we need to make this a separate account. So many people mix it. And when you mix it, you have a big balance in your checkbook, and when we have big balances in our checkbook, what do? Spend it, yep. So with the escrow account, it might be like a checking account number 2, or it could be a savings account. Whatever it is, you need to segregate it. And let's say this came to $1,000 a month. We would want to set up some kind of draft, or often people can go back to their payroll department and do a few different direct deposits. So you could direct deposit $1,000 right into this account. Very important to do this. And this is really what helps take a lot of the stress off you. Believe me, it does it. When you have something happen with your car and you have the money to pay for it, it's a lovely thing. It's great. Now, for the discretionary stuff, I have this crazy idea about what to do with discretionary spending. Pay cash. Think about what would it feel like if you actually paid cash for the discretionary stuff. How you could do this is, let's say that it comes to let's say like $1,000 a month is what you on average spend in this area. What would happen if you gave yourself a cash allowance every week? So maybe they do it twice a month, some people do it monthly, some do it weekly. But let's say that every Monday you went out and you got $250 in cash. And you had that with you. Either you keep it in your purse, or if you're uncomfortable carrying around large amounts, you could keep some in a drawer at home. And during that week, if you went to the grocery store, or if you went to buy gifts, or whatever it was, what if you actually paid cash for it? You would know if you were going over budget, right? Because you would be through your cash, right? So if you think about it, when we pay cash for things, it changes the way we think. A lot of people say that when they go into Target or Menards, you can't get out for under $100, right? So think about if you went into Target and you knew you were going to pay cash for everything that went into the cart. You're going to stop and think. There's some connection. And I'm not talking debit cards or any of that. It's like the green cash, you know? If you move to paying cash for these things, you will never have credit card debt again. Now let's talk about this. How do you get to kind of this change? Because it is a shift in always pulling out the credit card or debit card or check when you're going to Target or when you're going to the grocery store. You have to kind of make a shift in how you think about this. If you're putting money away into the education savings accounts and into your retirement accounts and into whatever to meet your goals, and if you're not going into credit card debt, your system's fine. However you're doing it is fine. But if you're not, if you have credit card balances, or if you're not able to put money into the 401k through work because you're spending, you need to kind of change and do something different. So this is just one way to do it. When you're going through your dissolution, there are some things you want to be aware of regarding taxes. And some of the things that are going to change are, like, what is your filing status? What's going to happen with the exemptions? What about the child care credit, the daycare flex account, those kind of things? And it's important for you to know that there's certain things that are not negotiable. You just have to follow IRS code, and whatever the IRS says, that's the way it goes. But there are things that with your spouse you can negotiate on. And with this, you don't feel like you have to memorize all of this. Just, if this later then just triggers something when you're sitting in your attorney's office, you'll just think to ask a question about it. So you don't have to memorize all this. But what you cannot negotiate is what your filing status is, okay? So by filing status, I mean most of you are probably filing joint right now. Following divorce, there's going to more than likely be two choices: single or head of household. If you are the one who if you have a child in your home that's in your home more than 50% of the time, you qualify for head of household filing status.